guys, Sean Moore here with the message of the day. Today's message is regarding the importance of early retirement planning. Now, would you agree that retirement planning is something that's fairly easy to put off or worry about later, especially when you're young? After all, in your mind, everything sorts itself out in the end, right? But what if it doesn't? What's your plan then? The problem with that strategy is oftentimes life don't work out the way we plan. And if it doesn't, you'll put yourself and your family in a less than ideal situation. The best way to avoid that is by planning for your retirement. Now, chances are you're not going to work forever. And you may envision your dream retirement to be on the beach, sipping on a cocktail, traveling the world. But actually, it takes serious financial planning in order for you to make those dreams a reality. That's why it's important for you to sit down with your financial service professional and have these conversations. Put together a plan. Because if you fail to plan, you're planning to fail. Once again, my name is Sean Moore, and this is the message of the day. Thank you, and many blessings.
Blessings to everybody that joined us tonight. I have the privilege of having this man with us today. He is financial advisor, my cousin, my brother, Sean Moore. Sean, thank you so very, very much for joining us tonight, man. I'm not going to keep you because I know you're a very busy man. But listen, I just wanted to say again, thank you so much for joining us.
Actually, I should be thanking you. You don't even understand how excited I was when I found out that you had this platform and that you actually asked me to be a guest on it. That was an honor within itself because people don't realize that we're not just cousins. We're actually brothers. And that's how we grew up. And for you to be doing this, brother, I'm super, super proud of you. If I have never told you that, I'm telling you now. Not only are you a good man, you're a fantastic husband and an amazing father. So I'm actually honored and feel blessed to be on your show. So thank you for having me, my brother. I appreciate you so much.
It is, like I said, man, we grew up together. And just to paint this really quick picture for everybody out there, our mothers are our sisters, yes, but they were very, very best friends. And it goes so much to say that when, you hear it all the time when people say, I grew up with him. No, we literally grew up with each other. It was, where's Michael? Oh, he's at Aunt Ingrid's house. Where's Sean? He's at Aunt Margaret's house. And I mean, summers, we grew up playing football together. And you know what? We weren't blessed and honored like most. And I won't go too deep into it right now, but we'll visit that again. We didn't grow up with our fathers. But we did grow up with very, very powerful men in our families, our uncles, and our mothers, man. Yeah, we gotta give it up to our mothers, bro. We really gotta give it up to our mothers, man. Because when my uncles and everybody wasn't around, Aunt Ingrid stepped in. Michael, what are you doing?
Yep.
Don't be giving my sister a hard time. Sean, what are you doing? Listen, don't have my sister call me again. So it's things like that which brought us to this point.
Absolutely.
It brought us to this point. But listen, you're a grandfather now.
The sound of that. Let me tell you something. I embrace it. I embrace it 1000%. As a matter of fact, this Christmas was even more special to me. I got to be honest with you. Christmas leading up to Christmas, was very depressing. And that's because, let's call it what it is. Our family that we grew up with, the traditional Christmases that we used to have, everybody get together, family time is not the same anymore. My mom's not here. My brother's not here. My cousins is not here. We have uncles that's not here anymore. So it was really not the same for me. But my youngest son, Shane, he came in the room one day and he said, Dad, I understand what you're feeling, but now you cannot be like this. You are now the leader. You are the grandfather. You have to pass down the traditions that was taught to us and now instill it into our grandson, my grandson. So I had to say, wow, I didn't look at it from that standpoint. And once I thought about it, I got excited again. And I am so glad that I was able to go over and spend time with my older son, Sean, and his family. And to watch my grandson indulge in his Christmas was amazing. By the way, wait, let me show you this real quick. There's a lot of truth to this right here.
I
Granddads,
love it. I love it.
grandpas are dads without rules.
I
And
love
that's
it.
100% right because guess what? I refuse to be the disciplinarian. My son's job, that's his job now. So I literally embraced it and I sent a message to my son, literally passing down the torch. My job is done. I got two grown men. Well, for the people that don't know here, that I was a single dad raising two boys by themselves. Now they're men. They're, and I'm so proud of them. So my job is done. Now it's time for me to cultivate and develop a relationship with my grandson. And that's what I'm looking most forward to. But yes, being a granddad is an amazing feeling. And we don't want you to learn that yet, okay? But you will one day learn.
So, well, listen, man. Yeah, brother, it's. Oh, I can't wait to get to that point, man. Honestly speaking, I can't wait to get to that point. But
Yes,
I have a
yes,
question.
yes.
I have something I want to leave with you, but I want you to answer it now.
Okay,
But I do want you to think about it.
got it.
And next time you visit us again, I want an answer. So you're a grandfather now.
Mm-hmm.
So my question is, what legacy are you going to leave for him? Not your sons,
Ooh,
but for him.
that is a good one. You want me to answer that now or you want me to wait?
You know what? Go ahead. I want you to answer it.
Well, here's what I want. Because growing up, as you know, we didn't have people talking to us about finance and we didn't have anyone talking to us about, how to prepare for the future and things of that nature. So what I want to leave for my son, which is going to happen because my actual son is my business partner as well, Sean Jr. So now that we are in that space, my thing is I want to leave my grandson with the knowledge, number one, not only the knowledge, but also let him understand the value of what it takes to start preparing for your financial future. And that's something that's extremely important to me. That's something that I'm so super passionate about, something that I do every day of my life to make sure we're educating and teaching the community to better prepare for our future. Because at the end of the day, call it what it is. We know we do whatever, but we don't prepare for our future. We live for the now. And everything that we do now is not going to matriculate to anything for the future. And that's something that I want to leave with him and also everybody in that younger generation. Does that make sense?
No, it makes a lot of sense. So listen, I'm trying to hold it, man, but I can't hold it much longer. Explain to us exactly what a financial advisor is, because I also have questions, but give us a little bit of a briefing of what a financial advisor is.
Okay, so basically what my job is, I take a comprehensive approach as far as helping you as the individual or family prepare for their future or prepare for retirement, things of that nature. So people don't realize how incredibly important it is for us to prepare. Think about it. When you are taking an exam, do you just go and pass the exam that day? No. When you played sports, when we played a championship game or any type of game, did you just go to the game and just start playing? Absolutely not. Took practice and you study. Those are vehicles of preparing. It's preparation. So I help you see what's the inevitable, what's going to happen eventually. And I help you try to avoid the little mistakes that might come up on. So for example, let's say, how important is it for you if you got hurt or injured and you cannot no longer perform your job duties, right? How would that affect your paycheck? Would you be able to pay your mortgage? Would you be able to pay your light bills, your gas bill, your car bills? How would that affect you?
If you'd asked me that question about a year ago, I said it would have completely devastated us, you know? Um, but I will say this, because of you and what you do, it has piqued my interest. So from there, I started doing little things and putting little things in place. The 401k, learning about the stock market, things like that. And I'm sure there's more that you can teach us. And after this is all said and done, I will be calling you, definitely.
Absolutely, absolutely. You know, I know you and I've been playing around phone tag. You're busy, I'm busy, but we got to stop making that as an excuse. We got to sit down and make time for each other. But to my point, what I was saying is that you got to make sure that you have written strategies in place. You're not going to just say, okay, oh, I'm injured now. Let me apply for disability insurance. You got to put that in place beforehand. So my job is to make sure that we have the conversation before it actually happens. Put things in place, put down or put in written strategies. Another example is this. What would happen if, or I asked the question, how important is education for your kids? It should be very important. At the end of the day, what happens when your kid decides they want to go to college and God forbid you're no longer here because you passed away and now they don't have money coming in, so they can't go to college anymore. You can actually prepare for that. That if you're not here anymore, you can make sure you put something in place, a written strategy in place to make sure that they still would attend college. We don't think like that, or the majority of us don't think like that. It comes and it happens, and if it don't happen, then that's it. We throw it out the window. We have to start preparing. So I help people to identify the avoidable things that's going to actually happen eventually.
So, and I tried to hold this question, man, but I really can't. Low income or mid to low income, I should say, families. What type of policies are available and which would suit their needs best? I've always wanted to know about that.
And now you're talking about life insurance?
Yes, sir. I'm sorry, life insurance.
No, that's okay. No, that's okay. Well, let me tell you this, man. People have a misconception about life insurance. They think that it's some astronomical number and also that they're going to be wasting their money if they pay into a policy. But there's a couple of policies. There's quite a few different policies that will have to suit your needs. Now, that's what it's all about. It's all about how do we put something in place that's going to suit you. Now, you don't need a lot of money. You don't need millions of dollars. You don't need thousands of dollars. You don't even need hundreds of dollars. You got to do is be able to sit back and say, okay, this is my needs. This is my job, by the way. Find out and identify your needs. Find out how can you put something in place and let it fit your budget. If it's not something that you could afford totally to fit your needs now, still start with a small policy. You can say, hey, Sean, listen, I only have this much that I can spend monthly without breaking my bank. You know what? I would say, okay, let's start it. Because what you're actually doing, you're building a financial house. Now, think about the terms of about building a house or how a house is built. Think about from the bottom up, right? Is your house built on mud or sand? No, it's built on a solid foundation, right? That's the same thing when it comes to building a financial house. That foundation is the insurance area. You got to have protection. So you got to put something in place to make sure the house, when it falls, it has some things that you can that can protect it. For example, if I gave you $1 million today, okay, your last $1 million, how long do you think that will help you protect you? How long do you think it would last you? I should say.
In this given day and age, not very long at all, man. Not very long.
Give me a number. Would you think that it's going to run out?
As far as You said
Like,
give me a number.
okay, so say for example, it's your last $1 million, you're retired. Let's say that. How long do you think the money that I give you, $1 million, will last you from the time you retired until life expectancy?
But I know it wouldn't last long at all.
Okay,
Because of all of things that just on a daily basis of what we put out of our pockets for the kids, and whether it's insurance for home, car, life, groceries, it's expensive. So $1 million is not going to move the way it moved 5, 6 years ago.
yeah, okay, and I can
So
respect that. But let me give you a more technical answer and let you
okay,
understand where I was coming from with that. So when we talk about life expectancy, we're talking about, okay, from the time you retire, whatever that number may be, until your last date. Okay. Your money has to last you enough so you can say, okay, you know what? I'm not outliving my money, meaning that this is my age, this is how much money I have, that my money lasts as long as I live. You don't want your money to be here and you're still going on. So you got to make your money last. So if I say your last $1 million, guess what happens if you don't have no protection in place? Your $1 million is not going nowhere because put it this way. Right now you're retired. You have $1 million. That $1 million got to last you until like life expectancy. Life expectancy has now been extended to like 90 for women, 88 for men, around that age. Now, if your $1 million, right, has no protection in place, it's not going to last long. Watch what I'm talking about. That $1 million is going, going, going. Okay, you get sick. What happens? You got to take that money and apply it to medical bills. Your money's going now. It's even shorter now. Money's going to go. You have an emergency. You got to take that money and make sure you pay that. Now your $1 million is even more strong. It's going to last you even less years than you anticipated. So how do we protect that? Guess what? We got to build a foundation of protection. What does that mean? That means that, hey, if I get sick and I got $1 million, I have medical in place so that I'm paying insurance for my medical insurance so that I could apply that and still let my money grow. Now, if I have an emergency, hey, you know what? I have an emergency fund that if something happens to me, I don't got to touch my last. I have a fund where I can go in and take out money just for emergencies. We got to start thinking like that. And that's what I help people to understand, how to put together the financial strategy to make sure that when we build that house, that not only are we building the foundation, we have to start preparing for the accumulation. But at the end of the day, that roof is the preservation. So they say this, it's the saying goes, it's one thing to make the money, but it's another thing to keep the money. And that's what I try to do and let people understand how to build a financial house. So getting back to your question, as far as the policy is concerned, and you don't have that much income, brother, it doesn't matter. Start something small, because God forbid you pass away and you don't want to do GoFundMe's. You don't want to push your family off because you didn't put nothing into place. So that's the answer to that question. I hope that answered your question, I should say.
oh yeah, absolutely. And I think that's one of the biggest things for me. Moving out here to Texas from New York, I it is a different atmosphere. And the one thing that out here is it's family first. It really is in every aspect of it. And with that being said, when you're around money, you think different. And seriously speaking, like we are, we are where we live. We are around money. There's just no other way to put it. It doesn't mean that we have $1 million at
Right,
any
right.
given time, but it's just that the thinking pattern is different. So getting into the stock market and really truly investing and just thinking wiser about your money aspect and how in your financial aspect, I should say.
Right.
Yeah. So,
That's
I
that. By the
really,
way,
I
that's
truly
that's
get it.
that's an awesome question, by the way, because that's one of the reasons. That's one of the main reasons I think people are hesitant to sit down with an advisor. They feel like, you know what, it's going to cost me X, Y, Z, and they. But if you just take the time out and just sit down and just lay it out on the table, all he's going to do is give you advice, or he's going to explain to you what the things you need to do, and then you can go from there. You're not forced to do anything. You just got to have the knowledge and the understanding and say, you know what, okay, I got to protect my family. I want to put that in. I want to put things into place.
Let's talk family really quick. can the policy be adjusted or upgraded in the future and at any circumstances change? If
That's
any,
awesome. Awesome question. You know what? So it depends on what company you're dealing with. So when you say upgrade, are you talking about buying more insurance later on, or you're talking about making it from one type of policy into a different type of policy?
you know what? I'm going to leave that to you to better suit my needs. I want you to explain, if you can, in a short span, or try to, the difference.
You know what? I like that.
I'm a true novice at all of this.
And I love that. And I love being a novice, you're asking great questions. You know what? Let's go look at, I think it's better if I show you the illustration and basically kind of give you an idea so people can have visuals, so they can actually see it. We can go to the illustration. Okay. Yeah, this slide right here. So
right there.
Yeah. So we're gonna look at life insurance provides a backup plan for your family. What does that mean? Okay. So there's two types of life insurance. There's two types of basic life insurance. Now, if you scroll down, and I'll give you a better, go to the next slide. Okay, stop right there. So I'm going to break it down so you guys can understand the differences between the two policies that you see right here. So a lot of people hear about the term policy or term insurance, and a lot of people don't know about the whole life insurance. So let me explain term insurance real quick. Term insurance is like you're renting a home, okay? So what I mean by that is that if you're renting a home and you go to move out, does your landlord go to you and say, "Hey, Mr. Hardy, thank you so much for staying here all these years. Let me give you back all that rent you've been paying while you was living there"? Absolutely not. They're not doing that.
I wish.
But while you were there, you was paying rent for what? Each month to give you protection. Whether it's from the rain outside, the sleet, the snow, the crazy people if you live in New York, you was protected every single month, okay? And you paid a monthly rent for every month that you lived there. You paid monthly rent. When you moved out, guess what? It's gone and done. That's the same exact thing for life insurance, for term insurance. I'm sorry. Term provides protection, okay, for your family. How do you do that? Michael, you have a home, right?
Yes, sir.
Now, you don't have to give me the number the correct number, because you don't want everybody to know in your business. But let's just say you have a $500,000 home and you have a 20-year mortgage on that home. Would it affect Danae if something happened to you? Would the financial burden fall on Danae and she can no longer handle the bills?
I would say so.
Okay.
I would say so.
One of the biggest causes of homelessness is when a couple, one spouse passes away in the couple, and the living spouse can no longer pay the bills. Guess what? They lose the home. One of the biggest causes of homelessness. So you can actually protect your family by saying, you know what? I have a $500,000 mortgage with 20 years left. I want to take out at least a $500,000 policy, so that if I pass away within these 20 years, this money goes to the house and it pays it off. No problem. That's protection. You just protected them. Okay? If you have kids, how important is college for your kids? If you say college is important, okay. If your child's 4 years old and now you say, at least I want to have my child go to age of financial independence. That's around 23, 24. Okay. I want to make sure that my child goes to college. So I'm going to put aside at least $100,000 in life insurance and term insurance to make sure that if something happens to me within those years, that my child can still go to college. You want to make sure that your child has some type of money. Life insurance is the easiest way to transfer funds from one to the next upon death. I'm making sure that I put together $1 million policy so that if I pass away, my children, my wife have at least $1 million. So you actually are breaking down the needs of the insurance policy. You don't just say, "Oh, I want $1 million policy." No, you got to actually strategically put it together and say, "Okay, this is what we need." Now, after 20 years, if you're still alive, you don't need the policy anymore. It's done. You already protected your family if something should have happened to you. Does that make sense so far?
No, it does. Absolutely.
Okay. So I want you to think about a machine. Think about a machine that cranks out money for you every single month, enough money to pay your bills. That machine is cranking out money. Now it breaks. If you want insurance on that machine, in the event it breaks, I can put that. I can apply the insurance so that I can fix the machine to make money for you again.
Hmm. Okay.
Did you understand the question?
I did.
So typically, you will want to put insurance on the machine because you want to make sure that machine's up and running to continue to make money for you. You guys are the machine. You are making the money. You got to make sure that the income that you are making is going to be put in place if you're not here anymore. So if you made $100,000 a year and you get a $300,000 life insurance policy, guess what? It's only going to last 3 years because you're only securing it for 3 years. The $100,000 that you're making, you're only putting it in place for 3 years.
I never looked at it like that. Yeah.
Nobody does. Well, I shouldn't say nobody does. A lot of people do not understand it. They say, "Oh, I'm set." That's one of my biggest pet peeves, by the way. When they say I'm set, without even sitting down and just having a discussion, you got to replace the income because you're no longer here with us anymore. So that's what you got to think. So when you're sitting down with an advisor, he's putting these things into place. Now, here's the good thing: term insurance is the least expensive one because it's giving you a lot of coverage for a smaller price because it's not going to be there long. It's not going to last long because you're only doing it for a certain term.
Right.
Once the term is up, you don't need it anymore. Does that make sense so far?
No, it does. Absolutely. It's a lot clearer. Thank you.
No problem. Now go back to the downside with term is that term does not generate cash value. No, go back up. I'm going to go back to I want to talk about the whole life now.
All right. So let's go back.
Right there.
Okay.
So before we go on, term provides the temporary coverage. It basically is economical because you don't have to pay a lot into it in order for you to put that into place. Another thing, it protects your for funeral expenses. So I want people to understand this. There's an acronym. It's called FEMER. FEMER. So I'll break down the F for you. The F is for final expenses. That means that for your funeral expenses, you want to make sure you put something in place so we're not doing GoFundMes. Let's have final expenses. The E is for emergency. If something happens, you want to have an emergency, you can actually go into your policy and take money out for an emergency. The M is for mortgage protection. We just talked about that. The other E is for education. You can actually put something in place for your kids' education. And the R is for retirement. That's what life insurance is typically used for. But certain policies do certain jobs. So going back to the term policy, term is really good for the death benefit. Something happens, yeah, they get to have the whole death benefit. $1 million, the family gets the $1 million. Now the only thing is, it doesn't build cash value, and I'll go into that with the whole life policy. So you're paying for the term, and it's like putting money on your cell phone. How many times you put money in you put insurance in your cell phone, and it never breaks? But you want to make sure, though, because I was really cheap one day, and I tried to be all cool, and I was like, no, I'm not putting it on. That same day I bought the phone, it cracked.
Wow.
Yeah, $1,000 phone. And I felt the pain of that. So think about it in terms of life, and this is something that really breaks my heart, and it's something that I get emotional about. But my uncle, and I'm sorry, guys, but this is something that really to this day bothers me. I try to get him involved many, many times, and we never sat down. And when we went to go sit down, he didn't even show up for the meeting. And I was really upset with him, and I kind of waved him up, like, yeah, whenever he were. And who would have known at 56 years old, he's no longer here with us. He had a family.
Oh, yeah.
That broke my heart. It broke my heart. We did a GoFundMe for him. Thank God he knew a lot of celebrities, and he knew, so they was able to put together, it was unheard of. I think he generated over 100,000 in less than 3 days or something like that. That was unheard of. But that, you got some people that breaks up families because of it. Hey, man, you know what? The last person that died, we did the same thing. I'm always giving the bulk of the money. They go to the person that's making the most money in the family and expect that person to always shell out money. It's not fair to them. So we got to make sure we're sitting down and just having the conversations, put something in place, because when you're gone, your family suffers, not you. Anyway, does that clear up term, by the way?
No, it does. It does.
Okay.
So speaking on the family aspect again, how much coverage do I do or what I need to adequately protect my family?
Well, what we need to do is, as far as sit down, I do what you call a fact finder. And the fact finder consists of a couple of questions. Number one, do you have a home? Do you own? Do you? How many more years do you have in your home? How much money do you have left in your home? So that right there is going to be one portion of it's called the needs analysis. That's going to say, okay, I will need X, Y, Z for my home to make sure that if something happens to me, I want to protect. Then I say, okay, how many kids do you have? Do you want the kids to go to college? Or your kids already in college? Or do you want your kids to have excellent? You can literally pick it up. Okay, I want Michael Jr. to have this much. I want, you can literally put it into place. Okay, you can leave each child a set amount by designating the beneficiary. And of course, your wife. You want to make sure your wife has a substantial amount. Life insurance is the easiest way to transfer wealth from one to the next. Because guess what? We are all going to die. We just don't know when. It's the inevitable. But when you sit there and wait and take your time, you don't know. That might have been too late. Okay, does that answer your question?
Absolutely. And I'm trying to write down as fast as you talk. So
listen, you and I are going to sit down and have our own conversation. But I want to explain the whole life now, because that's a different monster. That's the one they don't tell us about. That's the one that literally the world is based on. To be honest with you, if you can go back to that slide. Yeah, I know I talk fast, but I talk with a lot of passion because this is something that I'm truly passionate about. Okay, go back up.
Yeah, this thing, you got to forgive me, guys. It auto plays as soon as I move them over. So just let me know which one.
Yeah, right there.
Okay.
Okay, now this side, where it says for sale, is a monster. This is a monster. People don't know, and I ask so many people, hey, do you know that life insurance has cash value? You know why it's called life insurance? It's because it has living benefits to it. It is for your life while you're here. So this right here is more expensive. However, you're paying for the cost of insurance. Let's get that clear, guys. I want people to understand you're paying for the cost of the insurance. However, it builds cash value. Now, you got to be careful what company you're dealing with when it comes to cash value. Because if you're dealing with, everybody's not the same. All life insurance companies are not the same. Some companies might not have dividends, and other companies may have dividends. Now, if you have a company with dividends, and that dividends hit on top of what we call the compounded interest, that money's going to grow faster. And this is guaranteed growth. As long as you're paying your policy, you're guaranteed to have cash value grow each year. Meaning, if the stock market goes down and plummets, your life insurance policy, your whole life policy, still generates cash value. And it's guaranteed to go up each year. So let me give you a quick rundown. This right here is a whole life policy. Whole life policy is like buying a home. Think about it. When you buy a home, you have equity in your home, right? You can borrow. You can borrow, and actually take that money and use it for other things. Now, think about it in terms of the life insurance policy. You buy a policy, yes, it's going to cost you more in the long run. However, if it's structured properly over the years, and if you have a good policy, the cash value will eventually exceed the premiums that you paid all those years. And I can show you that one day when me and you are sitting down. And if anybody else wants to sit down, I'll show them that one-on-one. But guess what? That cash value that you're generating, guess what the benefit of that is? It's tax-free. When you take that money out, you don't pay taxes on the money that's in the policy. That's number one.
Okay.
Number two, if you owed money to a creditor and they call you on the phone, they can freeze your bank account. They can freeze your investments. But guess what they cannot touch? They cannot touch the cash value in your life insurance. It's protected. If you got
I like
sued,
that.
if you got sued,
Yeah, we got to sit down and talk.
guess what? That money that they suing you for cannot be touched in the cash value life insurance policy. Okay? In the event, now we don't want to put this in the atmosphere because you and Danae have been together for so long. In the event of a divorce, guess what? Spouses cannot touch each other's life insurance policy, the cash value in it. It's protected. People don't know that.
Okay.
And once again, it's growing tax deferred, meaning each year you're not paying taxes on it. And then when you take it out, guess what? You don't got to pay taxes. So that's the beautiful thing about it. And these people have been doing this for years. If you look at the story about Walt Disney, have you ever heard that story before?
I haven't.
Okay.
But I have time.
So Walt Disney basically could not get a loan from any of the banks. He went to bank to bank to bank. No one seen the vision of an amusement park. Really? You want to have an amusement park? I don't see that working out. Guess what he did? He went into his life insurance policy, took out $60,000 and made it into which is one of the biggest conglomerates in the world today. Every kid I know, every adult I know wants to go to Disney.
I was going to say.
And it's a huge. Can you imagine? He took that money out and made much more money with that money. That's what people do with businesses. They take money out of the policy. They put it into a home. That home makes money. They put the money back into the policy. It's something that people don't talk about. A lot of us don't know about it. And that's what I help people to understand it and understand the beauty of having it. Now, I hope that answered your question as far as the different kinds of policies.
Oh no, it did. It did. Like I said, I'm still trying to write down as fast as you talk, man. But
yeah, I know I speak fast. I know I do. I hope everybody's following me. But anyway, if anybody needs me to repeat it, or if you feel free to sit down with me, I free consultations, no charge whatsoever.
Yeah, no, we'll make sure we post all your contact information. We'll get that on there. But I just got to say thank you, man. This is very educational. And you know what? I was trying to read up as much as I can because I knew the interview was coming on, and I didn't want to seem like I didn't know anything really about it. I didn't want to seem unprepared.
No, but you asked the great questions, man.
But this is really interesting. It really is. It's almost like learning the stock market. Because I taught myself the stock market, and
that's beautiful. But we'll talk about the stock market because the stock market is great, and I don't ever talk against it. However, it's unpredictable when it comes to retirement planning. When you have retirement planning, depending on your age, you can actually benefit from the market. But as we get closer to mortality or closer towards death, you can't take on those risks anymore. So you got to be careful, and you got to become more conservative. I guess your investment strategy switches. You be more in safe securities and less aggressive. But when you're younger, you could be aggressive because the market crashes. Guess what? You can recover from that. But I want to talk something real quick about the type of companies you got to look out for when you're dealing with financial institutions.
Okay. You need me to switch over to the presentation?
Not necessarily. I think I can talk without that.
Okay.
But it's important to understand a couple of things, and I want everybody to write this down. Number one, you want to know how long the company's been in business. Why is that important? Because if a company's been in business, say for over 100 and something years, you know that company is going to sustain hard times. Because think about it. Over 100 something years, how many economical crises do we have? If that company is still around, you know that's a good company. It's a solid company to put your finances in. Okay, number two, you want to make sure that there's two types of company. There's a stock company, which is basically they are catered to the public. So that means that they're more concerned about the stockholders. And I'm not going to say they don't care about the policy owners, but they're mostly focused on the stockholders, as opposed to a mutual company. A mutual company now, it's a mutuality between the company and the client. What does that mean? That means that if the company is profitable, the client's going to be profitable. How? In the form of a dividend. So if the company declares a dividend, guess what? They put that in your policy. They put it back into your policy. So you got to think about it. If you say, for example, a stock company and your cash value is growing and you think it's growing and there's no dividend hitting on top of it, how much can it really grow? But if you're with a company that not only has compounding interest and the dividend hitting on top, do I need I say more? And you got to be careful and find out the track record of the dividends, because not every year dividends are not always guaranteed. So find out, hey, did you guys ever miss a dividend? What happens when you guys are not profitable? Ask those questions. Ask those questions. But I'm gonna show you on the actual illustration. I want to show you how you can actually find out if the company is really good or not.
All right, let's get back over there.
Yeah. I think it's go back up, I guess.
Yeah, no, I will.
Okay, no problem.
Let me know when to stop. I'm gonna stop here. You want me to go? You want me to go forward?
Can we go up? Can we go backwards?
Oh, we'll go backwards?
Yeah. There you go. That's right here. This right here.
Okay, that's what you want? Cool.
Yes. So you basically want to know the financial strength of a company. All you're going to do is ask, hey, man, what did the rating agencies give you? So there's 4 rating agencies that can go inside the company, and basically what they do is they make an assessment. They analyze the company and they come out with a letter grade. It's almost like going to a restaurant. When you see these fancy these great restaurants and they talk about how great the food is, or say if the boys call you, hey Mike, what's going on, man? Listen, let's go to this really nice restaurant. The food is amazing. But when you get there, despite how many good reviews you've heard, you get there, outside that door, it tells you whether or not you want to go inside or not. But by that letter grade.
Very true.
Now, because I know you for a long time, you're the type of person that don't play games when it comes to certain things. You're very meticulous. If you go to a restaurant, no matter how great it sounds, and you see a B or a C on that door, are you going inside?
Absolutely not.
So that tells you the same thing with these financial institutions. They can tell you how great they are. They can tell you how fantastic the company is. All you got to say, hey man, what ratings did you get from the rating agencies? 9 times out of 10, what they'll do is they'll pick out one and say, hey, Moody's gave us an A. An A might sound great because that's what we get to understand. Oh, A's on the paper. No, an A in the financial institutions, they're substandard. Okay, the highest rating you can possibly get, and across the board, is a AAA rating. So if you see a company that has a AAA rating, you know that's a good company. Okay. However, if you hear about the B's and the A's, you got to question that company. Why is it not up to standard? Okay, so that's just a good hint so you guys can understand.
And again, it's more information that I needed to know, because I do want to delve into this a little deeper.
And I can go forever, but go ahead. I'm sorry.
No. This, to me, we could talk about this, man, for hours.
Absolutely.
For hours. It's just more information that I can download. And I have 2 girls in school now. The twins are in college now.
Oh my God!
Yeah, man.
Like an old man. Make me feel like an old
man.
Man.
Yeah, they're in a university. There's not, and I will say that there is a difference as far as the price structure between a university and your typical college.
Yeah.
And and Danae and I, we were like, listen, no, you're not going to go, because they figured that when they left high school that they were going to go to community college. And I'll say this, guys, there's absolutely nothing wrong with a community college. I graduated from a community college, so there's nothing wrong with it. But as you grow, and my job as their father is to help them to get to the next level by any means necessary.
Awesome.
So yeah, and I'm truly excited about it, man. I'm really excited. And
you got beautiful kids, man.
I'm excited. I'm really excited, I'm also panicky too, because it's a beautiful thing. It's really a beautiful thing, but I want to make sure that it's stable.
Yeah.
You know what I mean?
Yeah.
They do the first semester, they do the second semester, and yeah, everything is great. But here comes the third semester, and we're struggling, and
Yeah.
that I don't want to do.
Yeah.
That I
I
don't want to
actually,
do. I want to make sure that their livelihood is straight. When they get past a certain age, like I told Jasmine and Kalon, when they get past a certain age, we've taught you everything that we could possibly teach you.
yeah.
It's time for you to go and do your own thing.
Brother,
So,
that is a great method, man. And I'm gonna tell you something. It's hard. It was hard for me because my two sons, I got two college graduates, and I gotta tell you, I had separation anxiety when they
oh
went.
yeah,
Yeah, man, it was hard.
oh
But you
yeah,
know what? I'm so confident that they're gonna do the right thing. They're gonna do the right thing. Oh, real quick though, I want to tell you about this. The best thing to do is to get them policies while they're young and they're healthy. Because if you get policies while you're young and healthy, the price of the policy is going to be less. That's what I'm about to tell you before when we talked about how much your policies will cost and everything. It all depends on your age and your health. If you're younger and you're healthier, you're paying less. The
okay,
older you are, and if you have any pre-existing conditions and things like that, you might have a problem as far as price structure is concerned.
okay, all right.
So you want to lock in your insurability when you're young.
So the one thing that our people struggle with is financial literacy. And that is one thing that I stress to the girls. I'm like, listen, you guys are here now. I need you to take a course, at least one course in economics, in, just to become a little bit more financial literate. I said, mom and dad, we had to struggle to get to that point to whereas we know what we know now. I said, it
Yeah,
didn't come easy. I said, but God has given you the ability to be where you need to be. So take full advantage of it,
sure.
because them leaving school and graduating with degrees and everything, they get fancy jobs and they get great paying jobs. But when they get out, they don't know how to manage the money. It's all for nothing.
Yeah,
At least that's how I think about it. And God bless my mom, man, for everything that she has done and she did to keep us safe and to in so many words preserve us. I just wish that the information that I have now that she had when she was raising us, you
yeah.
know?
And
I,
that's one of the biggest questions I ask. What was your relationship with your mom and your parents when it came to money? How often did you guys talk about it? And then a lot of them say we never did. And then what I also say is, how often do you talk to your children about finances? And some of them say they do all the time, but it's what you're saying to them. You know, there's a
right.
concept about save your money, but people don't understand that if you're just putting your money in savings, it's just sitting there. It's not really earning that much. So that means that how much is it going to grow? You got to put your money into things, not only in just your savings, but you got to make your money. You got to put your money into investments, things that's going to make your money grow. Let your money make money for you. Let your income become an asset. Don't let it just sit there and just thinking, okay, the banks are making tons of money off of you because they're giving you a certain amount and they charging by loaning it out a different amount. you
Hmm.
know. And I can show you if you have time, I can show you what I'm talking about with one of the illustrations. So basically, these are buckets. These are supposed to be buckets, illustration of buckets. So these are an illustration of where our assets are currently. Now, most of us have our money in bucket number one and bucket number two. So I'll give you a rundown of all the buckets. So bucket number one is what you call 1099 now. That's basically saying whatever I'm going to pay taxes in that particular year. This is right. This bucket number two is 1099 later, meaning that the money that's growing we're gonna pay taxes on it later on. It's deferred. And this one, 1099 never. You don't pay taxes in this bucket right here. And I know everybody's eyes are opening wide and they like, what, that one? But let me give you a quick breakdown. So in this bucket right here, this is your savings and CDs. Now, savings is a good, okay? If you want to have savings, okay, I don't deter you from doing it. However, just know that savings, the bank's only going to give you a certain amount. Okay. And if it goes over, I think with 10% or something like that, you got to pay taxes on it. Okay. So whatever you're earning, you're going to pay taxes on it later. If you have basically, what is it? Stocks. If you have the stock market and your money grows, you got to pay capital gains taxes. Same thing with real estate, and also your bank check. That's all in. I'm sorry, your business income. That's all in this bucket right here. So when you say 1099 now, that's whatever is going to be taxed in that year. Okay. This bucket right here is 1099 later. That says, okay, I'm going to take this pen and I'm going to put this pen in my pocket. Once I take it out of my pocket, now it's going to be taxed. So when in the pocket, it's going tax deferred. We're not having taxes on it. But as soon as I take it out of my pocket, it's going to be taxed at whatever rate it is at that time. So let's talk about the 401k. The 401k is a tax deferred item. If you're putting money into your 401k, say you're putting 6% or whatever it is, your money's not being taxed. And your money's actually what you call financial jail, because you cannot take out the money without getting any penalty on it before 59 and a half. Okay. So your money's stuck in there. So let's say you put your money in, it's growing. Now you're 59 and a half, taxes are at, say, 50%. You're going to pay those 50% tax rate at that time. So if you had $1 million put into your 401k and you never touched it, and now you go to take it out, your 50,000, your $1 million is going to be $500,000. The government takes the other half. How crazy is that? In that bucket is also your traditional IRA, and you have your other deferred compensation plans like the 403b and the 457s. But this bucket right here is 1099 never. You don't, whatever money you're putting in is already after tax dollars. It's your paycheck. But when you take it out, there's no taxes on it. This is your Roth IRAs. This is your 529 plans, your municipal bonds, and also your cash value life insurance. That is what's in this bucket. Rich people, they want to avoid these buckets at all costs. They dump millions into this one. Millions. And then once they put money in and they take the money out, they could take it out as a withdrawal or they could take it out as a loan. Take it out as a loan, the policy still grows as if you never took it out. So this is what I try to teach people. Learn how to diversify. Now go to the next screen. I'll show you what I'm talking about.
All right, so let's go.
And then we'll wrap it up. So this right here is basically it's a chart about diversification versus without diversification. So for example, let's take $100,000 out of bucket number 2. Okay, bucket number 2 is saying we're going to pay taxes later on it. It's deferred. But now you take the money out, $100,000, you're taxed at 22%. The government keeps 22,000. You're going home with 78,000.
Wow.
Yeah. So just think about it if it's even more, because we're anticipating taxes are going to be higher later on. So if it was at 50%, you're going home with 50,000. The government's taking 50,000. So you got to keep the. But now, if you want to diversify it, I'm going to use bucket number 2 and bucket number 3. So that same $100,000, I'm going to break it up into 50,000 for each bucket. So 50,000 coming out of bucket number 2 is going to be a lower tax rate. So you're going to get taxed on it lower. It's a lower amount, I should say.
Okay.
So 50,000, you're going to be paying like 6% on that. I'm sorry, excuse me. If it's 50,000, you'll be paying like around 12,000 as far as your taxes. The government takes 6,000, you go home with 44,000. But now the other 50,000 coming out of bucket number 3 is never taxed. It's not taxed at all. So you get to keep the whole 50,000. 50,000 plus that 44 is 94,000 versus 78,000. That's diversification. That's tax diversification. But that's basically it. Yeah, man. But this is some things they don't teach us. Don't teach us this. I sit you down and I give you a full presentation, and I'll break things down for you so you can have a better understanding on it. And I'm done with this. So I know it's a lot.
Listen, no, it's a lot. It's a lot, but it's a lot in a awesome way. Meaning, anytime you can learn something, at least for me anyway, anytime I can walk away with new knowledge, It's a blessing.
Yeah,
It
man.
really is.
And no one's sitting down and explaining this to us. So I want people to understand that when you're sitting down with an advisor or sitting down with someone, it's about learning and seeing how you could apply certain things. Don't sit there and act like you know everything. And even if you think you know, hey, it's okay to enhance your learning or to expand it more, because knowledge is power, and I'm learning every single day. I study this. I literally when I wake up in the morning, I'm going to a class that we have, a virtual class, I should say, and I'm learning more and more every day. Sometimes you might have a question. I might not know the answer right away. So you know what? I go in and I'll let you know, listen, I don't know the answer 100%. Let me find out and I get back to you.
That's it. I'll
I
get it
go,
for you. I
yeah,
mean,
I
I know
go,
it, but I'll get it for you.
I learn it, and then guess what? There's a one to grow on. And I love when I get questions like that, because it's important to understand how this works. Because I wish somebody would have told me this when I was in my 20s and 30s. Because if that was the case, I would have set things up. If you have a child, get your child a policy. Oh my God. Your child, my grandson, oh, talk about set. I'm not going to say no more. I'm not going to say any more. Now, you talk about leaving a legacy. That's what we're leaving him. And if you got a child, talk about juvenile policies. Get your child a policy. It generates cash value now. So when they're older, they have money for college. They have money for whatever they want to have money for. Trust me, guys. Sit down with someone. Have the conversation. There's a lot on the table that we're not being taught.
This is a perfect way to start the new year.
That's it, man.
Way to start the new year.
That's it. That's it. New Year's resolutions. You want to get your finances better. If you want to have the conversation, you want to protect the family, please reach out. I'm here to help. And follow me on Instagram and follow my messages of the day. I have so many of them. Well, actually, I started, but I'm going to be having a lot more, and it's going to be little tidbits that's going to help you understand. Oh, wow, I didn't realize that. And one thing we talked about is about successful people. You talked about you live in an area where it's pretty affluent. I'm telling you, your mind is shifted, because when you deal with people that have a positive mindset and a successful mindset, it's going to take you to that level.
It's just a total different way of thinking, man. And don't get me wrong. Don't get me wrong. I love from where I come from, man, because Brooklyn is what made me.
That's
honestly,
right.
I
That's
mean,
right.
truly. It taught me hustle. It taught me how to get up and move. It taught me not to wait for it, because if you wait for it, it's not going to come to you. You got to get up and go get it.
Brooklyn's a different planet.
So now I feel that God has put me, he says, okay, son, you learned that. You mastered that. I need you here now to refine it.
Yes, man.
And this is
you did the right thing.
This is what it is for me. It's refining it for me. So
you did the right thing, man. You did the right thing. You know, we miss you here, but you know what? You took your family and you put them in a different atmosphere, them in a different mindset. You know, and I commend you for it.
Absolutely, absolutely.
It.
It's just a thing of, and I thank my mother for that, man, because my mother was never one of the I'm going to sit on the sidelines and I'm going to do what everybody else is doing. No, my mother liked to travel. She liked to see different things, and to me, that's what it's a blessing. It's a blessing because my wife and to be married to a woman who has exactly the same mindset of we got to do this. We got to hustle. We got to do this.
It's a blessing.
I don't want to live in the same area where I grew up.
Awesome.
That's not what I want to do. That's not where I want to be. My kids deserve more than that. Let me show them it's okay to go out and venture and see another side of the world.
Absolutely.
It's a bigger place. It's a bigger place in Brooklyn.
Absolutely.
It's a bigger world.
And I'll tell you one thing. I love that woman, man. I love her so much, and I miss her so much. Your mom was incredible. Your mom was my second mom. And matter of fact, guys, don't chastise me for this, but when I was a kid, baby, I was gonna marry that woman. I told her one day, I said, I'm gonna marry you. I had no idea, but I that's how much I love her. And she was incredible, beautiful woman, beautiful soul. And that's something that when it took a big part of me when she left us. And I'm getting emotional too, and I'm not gonna do that on the podcast, all right? But that was somebody that That was incredible, incredible, incredible.
Yeah, you got
And
me over here tearing up, man.
no, we're not doing that here.
You got me over here
We
tearing
strong, man. We ain't.
up. Well, listen, thank you again, brother, for joining me tonight.
Brother, it is my pleasure, cousin.
Guys, this is Sean Moore, financial advisor. I will make sure his information is posted below. You can find him on Instagram at, and correct me if I'm wrong, is S Moore?
No, it's
Is S
Sean Moore.
Sean Moore.
SeanMoore, Senior 3.
There you go. That's him. That's his information. I'm Mike. This is My Truths. And again, we love you guys, and just keep an eye out for us. Like and share, and just stick around. I'm sure you're going to enjoy it. Happy New Year to everybody out
Happy
there.
New Year's, everyone.
Wonderful, 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 wonderful topic, man. A great conversation. I love you dearly, Cuzzo.
I love you more, man. I love you more with the Moore more.
Let me post it again. Let me get over to you. Let me post it again. All right, that's his Instagram, y'all. Y'all make sure you put all the information down. I've been flashing it throughout the course of the day, but I just want to make sure that it was there. So
yeah, man, send me a message. Follow me. Look at my messages of the day. I'm here, man. I love talking about it. So please feel free to hit me out.
well, cuz we got to make sure we do this again. So we're gonna
Absolutely.
after the show, we'll talk about the next stage and what we're going to talk about on our next visit. Yes, everybody, I'm gonna make sure that Sean comes back and visit us, because this was deep. But it was so it wasn't deep to where it hurt my head. You know what I mean?
And
Like,
that's why I try to make it as simple as possible, and I try to take out the jargon, take out the fancy names for things, because people don't follow that. They want to hear the real deal.
And that's what I loved about it. It's like, okay, I can get into this. I can actually really vibe and think about what he's saying, and mentally picture it, what he's saying to me. So, but I'm not going to hold you guys anymore. This is My Truths, and I thank you so much, very, very much, for joining us tonight. Look out for this man on Instagram. His word of the day. Awesome, awesome, awesome. Hey, Cuzzo, stick around after this, okay? We'll talk a little bit more. All right. Until then, guys, be blessed.
Happy New Year.